Well, it's the 25th month on hold now, so I guess no surprises really, but it's the same result again today. But I think it's more the expectation of a rise that seems to be creating the interest or the movement in the market, because certainly there's been a flurry of remortgaging already this year. I think brokers and certainly banks are seeing the numbers of people interested in looking at their rates again or moving to another deal has certainly been coming up already this year. What does it mean? People really need to look carefully at their own finances. I think people need to examine whether they can stand a rise in their monthly repayments. A good way to do that is to talk to a mortgage broker who can show them the range of other options out there and to check them against their own budgets to see if that's something that would be useful to them, and if they want to go with the safer option of going for a fixed rate right now so they can plan ahead, or to take a bit of a gamble, because that's what it is really. But the differential between trackers and fixed is such at the moment that some people would suggest it might be worth taking a gamble to watch rates rise, but staying, there's still about 1.8% between the average fixed rate and the average tracker rate at the moment in the market. So some would suggest that rates actually may not come past that in the 2-year period ahead. I think the flurry of activity has certainly made a difference in terms of lenders pricking up their ears. In terms of the amounts of mortgage products being launched into the market at the moment, we're definitely seeing a lot. In March, actually, for example, on the advisor side, there were 500 new products launched, these are sort of unprecedented levels for the last sort of couple of 2-3 years, really. So lenders are certainly moving into the market and showing more interest than they have, and looking at competing, certainly in some areas. So that's obviously resulting in more competition and better rates for consumers.